The new quarter brings more buying. S&P breaks above 4,000 as VIX collapses. Gold holds on to major support as the dollar and yields take a breather. All this and more on this week's Macro Insight. Welcome back to Macro Insight. Today is the 6th of April, and let's take a look at these markets. So what happened last week? So much for the quarter end rebalancing that was going to bring all these sellers of stocks that we were expecting. Didn't really happen at all, right? We had mentioned last week that it was going to be likely selling coming from the likes of quarter end rebalancing, but then it seemed that there was a counteracting buying dynamic coming from like the vol target and the quant funds, where the look back period for volatility was dropping out some of those extreme moves in March, and that could have actually added some buying flow throughout the week, and it seems that that's kind of the way it played out. And then just generally, right, you've been getting very strong data. So you had a massive non-farms beat on Friday. Obviously, markets were kind of, a shortened day in the US and closed in Europe, but you had strong beat there. You've also had very strong ISM non-manufacturing data come out in the US, like printing record numbers yesterday. And that, along with Biden's infrastructure plan that was outlined last week, coming in at around 2 trillion that he's going to try and pass. So, all these things have kind of fueled the optimism and helped drive the optimism. And, any rebalancing flows there may have been kind of paled into insignificance. Yeah. So, I had been looking for that dip to try and scoop up some, but then, I'm one of those traders who kind of lets the price action dictate what needs to be done, right? So I'd mentioned that I'd been trimming my shorts throughout the course of last week, and by the end of the week, I kind of had closed them all. I had also mentioned that I bought some NASDAQ when it broke that 13,300 level. To try and play a tactical rally, which, with a relatively tight stop, but that seemed to play out reasonably well. So let's have a look at some of these charts. And really, you actually just had this kind of S&P smashing through this big resistance that we'd had for a while, around just under 4,000 was the high before. And when we took 4,000 out, it just accelerated in style, right? So here's the 1 hour chart. After taking out 4,000, it just didn't look back, and we got as high as 40.85 yesterday. Yeah. So that's kind of what S&P did. NASDAQ, it had this level around 13,300 was the one that I felt needed to break to confirm the rally. We got that, and we had a quick 300-point rally. But it definitely opens up the way for a retest of those highs over, say, coming weeks if this bullish sort of dynamic continues. So wouldn't be surprised if we got a 14 handle on the NASDAQ over the coming weeks, basically, right? Now, the Russell, whilst it has obviously rallied, it had been consolidating. We'd said it was in this correction mode, and once the correction was over, we were expecting a rally. It's kind of been lagging a little bit relative to, say, the tech stocks and even the S&P. It didn't have a great day yesterday, but I don't think that's anything to be overly concerned about. I would still expect the Russell to continue to kind of grind its way back up towards those highs, if not through them, if the general sentiment stays bullish the way it looks like it will. Yeah, like we said, the data is just coming out too strong for the market to ignore right now. Now, usually the retail army tends to be, blamed for the market rallying, especially when it's rallying from the highs to even greater highs. But actually retail flows haven't been quite as big. Apparently, call option buying hasn't been as big. These stimulus checks that people were going to pile into the market maybe haven't really come through in the same way people might have expected. So that's quite surprising, yet market's still managing to rally. So arguably it's more institutional buying that's taking the market higher on the back of these confirmed stronger data that is coming through. Yeah. Okay, so well, also 10-year yields, obviously the big driver we had been saying that was keeping a lid on tech stocks. They calmed down a bit. See here, kind of momentum in these 10-year yields has kind of gone away, right? So even, we were at 170, 175, but not really picking up any momentum. You're seeing here, momentum indicator kind of sloping down. Whether it's the RSI or whether it's the composite, all of them kind of signaling that the 10-year yield move to the upside kind of running out of momentum. What else? So ARK, obviously ARK had been probably the sector, when I say ARK, I mean those high growth, those speculative names in the tech sector, long duration names, if you want to call them. They had been probably, the weakest on the back of what was going on in yields. And then looking at this chart in ARK, jury's still out on ARK, right? I'd say ARK's probably not out of the woods yet. So you've got this kind of triangle formation that we haven't really broken back out of yet. So kind of keep an eye on that. Obviously, if the next few weeks continues to remain bullish, given that it's a high beta sector, those tech names are going to probably break, and then we'll see a slightly more bullish kind of pattern emerging out of this ARK thing, right? So, but I have been flagging that the way, what the last few weeks has kind of shown us is this fragility that's built into the way these guys are managing their risk. And at some point, should yields have another spike to above 2% or whatever, then this could again be the kind of epicenter of the weakness. And we may see some more unwinding going on in this. So something to keep an eye on. Yeah. And right now I'd say the jury's still out on these stocks. So that's kind of the US. I mean, VIX also got slammed. If the VIX just keeps going lower and lower, that's probably a bullish sort of sign. So we bring up the chart on the VIX. Here. So I've said, VIX collapses to kind of pre-pandemic levels, right? So we've got, before that gap, we were kind of in that area of sort of 15 to 18. Pandemic gap took us into the 20s, and we obviously went much, much higher. Now breaking down again, right? So, VIX managing to get sort of on that 17 handle for the first time since sort of last January. Quite a big deal, really, right? If the new range, in theory, it's a good sign for markets heading into the summer with the VIX being like this. It is looking a bit oversold maybe in the short term, and you probably need a couple more weeks of low realized to really cement the lower vol regime. But if we look at the what the realized has been coming in at, you've got 30-day 17.5. So, if we can get all of those metrics into the low teens and it stays there for a couple of weeks, then it wouldn't be actually that surprising to see a 15 handle on the VIX going into the summer, right? So that's looking very possible. Yeah, so something to kind of watch out for. Now, remember some of the reasons why the VIX had been staying elevated were, institutions who were buying the market needed to buy downside protection to be able to do that. So there was a bid to vol and a bid to skew there. But there was also this unusual bid for upside that the retail guys were buying call options, and that was creating a bit of a vol bid to the upside. And then on top of that, you had funds that had been sellers of risk premium and sellers of gamma to the market, let's say, that maybe got blown up last year and weren't really able to do that, right? So there wasn't as much supply. So there was more demand and there wasn't as much supply. Now, as realized has been falling off, And like I said, people's sort of windows, look back windows, are allowing them to take more risk on. That kind of helps some of that selling flow come back. And there's been an absence of call buying from retail. So a few things have kind of culminated to take that bid away and bring some supply back to the market in vol. And that's taken vol down into this new regime. Yeah. So whether or not it can stay there, we will see. But if it does manage to stay there, then that will be fairly bullish for stocks in general. Yeah. I had been saying China looked a bit oversold last time we spoke. China did manage to stage a bit of a bounce. Bring it here. So China, we've got probably an hourly chart better, right? So we got a bit of a bounce. China, obviously the Archegos stuff, kind of hitting those Chinese tech names. Obviously staged a bounce from pretty oversold levels. Overnight, that bounce has faded a bit though, right? So China's come out and asked its banks to curtail credit for the rest of the year, right? Due to excessive loan growth and asset bubbles forming, right? So China is actively saying they don't want their banks fueling bubbles and lending and increasing credit, basically, right? So they're actively trying to contract credit in their economy, right? So that's, no surprise that the stocks took a bit of a hit on that. We've been talking about this, right? The policymakers in China have been saying they want to take the steam out of the housing market. They want to slow things down a bit. It's getting a bit frothy. So more signs of that coming through in China. And like I say, their stocks have got a bit of a hangover from the Archegos stuff as well. Some of those tech names are still getting hit. It's probably a bit of an overhang from the likes of Nomura and Credit Suisse holding onto that inventory. So Chinese stocks are still kind of working their way through this. To not really leading the charge in terms of equity risk. There has been some talk about China maybe leaning on the US stimulus, right? So China, knowing that the US is coming out stimulating and the demand that they're likely to see out of the US economy, given that they export to the US, that could kind of help see their economy do okay if there's demand coming out of the US, right? So maybe they're leaning a bit on that and thinking they don't need to do much themselves right now. And then maybe in the summer, when we get to they've got some big anniversary coming in the summer, maybe they come back and if they need to stimulate, they can do it at that time, basically, right? So I think there's a bit of gaming going on there in China. But that's something to keep an eye on, right? If China continues to roll over or does roll over, it's gonna filter through, particularly to commodities. And it may also filter through to something like European equities, right? And that kind of leads me on to European equities, which are having a stormer. The DAX has done about 10% in a month. So if you look at the DAX since kind of start of March, it's kind of been led by the autos, right? So DAX has done about 10%, led by the autos. Volkswagen's up about 50%. BMW's up about 30%. So, very, very strong. Like I say, it's been benefiting from this kind of value rotation, not just from a style perspective, but from a regional perspective, as people allocate back into Europe a bit, thinking that at some point they're going to get their act together on the vaccine front and they're going to get a reopening. But it does feel a little bit overdone in the DAX right now. You look at this RSI metric, it's super overbought at like nearly 80. And we kind of look back there, it doesn't really hit as high at those levels very often. It hit it back in kind of November 19 and again in summer 19. So, don't be surprised to see a bit of a pullback in the DAX in the short term, but, it's kind of establishing itself as a bit of an uptrend here. So, and I think it's probably been supported a bit by the weaker euro. So that is what it is, right? So, but like I say, if China rolls over, then that probably will have some impact on the DAX. And that's European equities. And then, in terms of what I've been doing with my equities, I had picked up a bit of NASDAQ as it took out that level that I thought was important, that 13.3. Just a little quick hit and run type trade. I've taken half the position off here at 13.6 last night, trailed the stop to be my entry point on the balance. And then we'll just see how that goes. If it can manage to run towards 14,000, then maybe I'll take the rest off. But that's kind of how I'm playing the tactical long. In terms of other stuff, I had been picking up, over the last couple of weeks of weakness. I've been picking up a few things that I liked, like those rare earths, and the some clean energy stuff. What else? India. I mean, they haven't really knocked the lights out, but they're doing okay. Picked up some cannabis as well. Cannabis sector's done all right. Was getting very, very oversold as some of those retail names were getting liquidated. So it had a strong bounce. So just a few little bits and bobs I picked up there that I'm still running. So that's kind of my sort of take on equities. In terms of key things to come this week, coming up this week, we've got FOMC minutes. So the big data we had was on Monday. We had very, very strong ISM readings coming out of the US. But tomorrow, Wednesday, we've got FOMC minutes. We've got ECB minutes on Thursday. So just central banks kind of giving more sort of clarity on what they're saying and their policy. I expect it to be relatively dovish, all of it, to be honest. And then piece of data out on Friday overnight. So Thursday overnight, Friday morning, we'll get it. It's China PPI. So some inflation numbers out of China. So we'll get a look at those. So that's the key data to look out for this week. If we move over to FX, right. So yeah, if we look at FX, obviously King Dollar is the first thing to look at. It had been charging, obviously, helped by what was going on in yields, etc. So if we look at the daily on this one, so it's kind of respecting levels, right? So, I've had these levels marked out for a while in terms of resistances. So it pretty much just tapped the 93.5 area and has come straight back down to the first level at 92.5. And that's kind of on this little uptrend as well, going back to late February. So important level here in the dollar. It may have a bit deeper pullback if yields can kind of stay calm. It may well, pull back towards maybe even as far as 91.5, 92. Sort of this probably if this level breaks here, then the next obvious support is going to be probably that 91.5 area where it had bounced a few times there. But if you believe in the overall kind of US growth kind of leading the charge here in terms of the reopening, then you probably expect you're going to see some more strength out of the dollar at some point over the summer, especially if you think yields are headed to 2%. Given that the yields are likely to be moving up faster in the US than they are going to move in Europe and things like that. So that's kind of here. It's a bit no man's land, but I suspect we're heading higher at some point over coming months, whereas we may get a little bit more weakness in the short term. That's kind of how I'm thinking about it right now. Yeah, not really playing much in the FX space. I had taken a short on dollar yen as it touched that 110 level, just as a because that was such a big level on a long-term chart. So I went short some 110s with a 111 stop, and I managed to not get stopped out by about 4 pips. So that was quite lucky. So I'm still short that from 110, but we'll see how that goes. I don't really have. It's a small position. It's not a massive conviction, but it was just me taking a little stab at that 110 level to see if it was gonna kind of act as any kind of resistance. Yeah. GBP, last one. So GBP kind of bounced off that 137 area quite well. It held that 137 area that it tested a couple of times. It was looking pretty good yesterday, up at above 139, but it's got faded quite aggressively today. I'm not really sure what the reasoning is behind that. UK's still on track for their big grand reopening next week, right? So everyone, obviously, we're all very excited about that. Let's see. I mean, for now, like I say, if you think the dollar's still got a bit more weakness in it, then this probably does manage to. It could even tap 140 again in the short term. Whether we're going to really break 140 convincingly, I don't know, remains to be seen, right? I think a a lot of the reopening in the UK and the kind of the fact that they've handled the rollout better is already priced in, right? So I don't think that's going to be new news to the market, really. Yeah. All right, so that's FX. And then if we look at commodities, so gold was our big call that we had been short. Obviously worked out pretty well. We covered our delta shorts down there at 1680, or most of them. I ran a sort of trailing stop on the balance, which got stopped out. So kind of took profit on those shorts. Kept holding some puts that end of May, because I still favor like the break to the downside. You know, as long as 1765, which is the key resistance, as long as that's not taken out, I think the thesis is still intact that gold's going to struggle. So yeah, I mean, I'm going to basically be launching some more delta shorts on from 1740 to about 1760. And then, you know, at somewhere above, if it breaks sort of 1765 or 1780 kind of area, then maybe I'll cut those delta shorts pretty quickly. But that's kind of what I favor as an entry to start getting short those again, basically short that thing again. So that's gold. And like I say, this is because I just have a tactical bearish view on gold for the summer, right? Because I don't think we've reached the end of this thing playing out, right, in terms of yields, in terms of optimism and stuff like that. At some point, though, you know, gold is, from a long-term perspective, gold's probably an okay thing to have in your book. I do think, you know, that whole argument about holding gold and why you're in gold, clearly the market has said that they like Bitcoin for that as well. And later on, when we talk about Bitcoin, I'm going to show some data on the inflows into Bitcoin versus the outflows in gold, just so you can get a sense of like the size of that. But yeah, you know, I think it's prudent to have some gold in the long-term portfolio, right? You just got to pick your moments as to when to accumulate it. And for me right now, I've got some. I'm not massive, but I do have some. But you know, I wouldn't look to really add any into that long-term portfolio until we get sort of on like a 1550 area, kind of like maybe in gold. That's where I'll probably add into the long-term portfolio for myself. Yeah. Silver, you know, not a lot new to add on silver. Still waiting for lower levels to maybe pick some up again. I'm not shorting silver. I'm not a big believer in that trade, like going short silver. I think it's a safer trade to short gold, so I'd rather just sell that, right? Platinum's been pretty strong, actually. You know, there's some talk about platinum being heavily used in the hydrogen energy game, basically. So there's that demand for platinum. That's why platinum's been having a bit of a catch up over recent months. Palladium's also been trading pretty strongly. I have some long-term positions in both of these, but they're not big. They're pretty small. And I'm not really adding or doing anything with them. Copper I did add to last week. I mentioned in the trades that I added to my long-term positions in copper, nickel, and I added some tin as well. You know, copper obviously has got a very strong fundamental backdrop. It has been consolidating. Did well holding above that sort of uptrend and above that 50-day moving average. So it couldn't really manage to get much lower, which was pretty impressive price action, I thought, given what was happening with China. So let's see if that is done now, if that consolidation is done. And I think we need to break above 420, above 420 in copper. Then I think, you know, it's probably confirmation that the up move is going to resume. And then we may well take out those highs at 440 or something, right, over the summer. So that's kind of what I'm thinking. But from my perspective, rather than waiting around and being cute for that 375 area, I was just like, right, I feel underweight copper in my long-term position, so I'm just going to buy more. So I bought some more last week, basically, yeah, which for now seems to have worked reasonably well. And then what else have we got going on in commods? Obviously, oil's been a bit choppy. It's like up 2%, very choppy. Like the size of these bars, you know, are, you know, a good sort of anywhere between $2 and $4, right? Some of these bigger bars in oil. So oil's been chopping around quite hard. I mean, I have picked up some oil around 58.5, looking for it to resume the rally along with all the other commodities. But for now, it's kind of, stalling. The thing about oil is if you're going to buy oil, you've just got to make sure you size yourself appropriately, right? Because oil is the most volatile of the commodities, and it can easily sell off a quick 15% in the blink of an eye. So something to be aware of. Yeah. But for me, I quite like buying oil on weakness. And I've got bids to buy it lower down if we go down there, right? So if we get to some of these lower support areas, sort of around that 55, I'd probably add, to be honest. So it's kind of how I'm looking at oil. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.